traders, the active traders, moved the market to the downside. Whether this is the way the market's going to follow through, who knows? But during that day, that's the way it was, and typically markets tend to follow through day to day what is going on there. This was on September 1, where the arrows are. The predicted low then was 14.48. So if we drop 20 cents below that to have our sell entry point at 14.28, we would then be in the market. Now, sometimes it may take a little while for that to occur. Sometimes it comes relatively quickly. But in this case, we would be dropping from down to 14.28. I'm not sure. Again, I'm just going to approximate somewhere right in there where it would have occurred on that day. And again, this is a situation of being prepared. And when you look at the indicators down below, you can see that the predicted differences are pointing down, and you can see that the market on that day did shift to 0. And so that suggests that a short position is indicated by the various indicators. As the market did drop down, you kept a stop 10 cents above that predicted high. The market kept drifting down and down, even though some people thought that the yields were deteriorating. There's not a lot of news there. Everybody would assume that there should have been some bullishness there. Wasn't there necessarily, or at least the market didn't see it as that type of a situation. But then we do get into a time frame here in early October, right in this area right in here, where the ranges start to narrow up. They start to be thinking about the possibility that the market could break higher because the range have started to tighten up. I think it's probably a result of sellers that have, they've been in this market. They've been short for quite a while, so they start taking profits, start covering their positions. As the market moves down, normally you would get new buying or expect to have new buying, like such from China or somebody. They can see the bargains that have been compared to the previous price, so they're in there buying. These types of things kind of, cause the selling pressure to run out of steam, and as it moves on down, then the question will be, at what point we want to put a stop to get out of the market, and at what point will then we potentially get long in this market situation. As we look at the situation with this one, we also see that as we get down to the bottom in October, we have a situation where the predicted differences, the lines that indicate the market momentum, start to move. They're starting to move to the upside, and we have the predicted Neuro Index isn't perfect yet, but if there are some potential buy signals. We had a series of different sell indicators here at the 0 line, but now as we get over here into October, we do get the indication that the price move, the typical price the next 2 days, should be a little higher. So we could be expecting a breakout kind of a situation to occur if we're prepared, because we have a situation where we, for whatever reason, the market did not react to some bullish enthusiasm we might have had because of the lower yield prospects, lower crop size. Now the question is, where do we cover on this? As I mentioned earlier, I like to cover with 10 cents above the predicted high. In that case, if I'm looking 10 cents above the predicted high, I'm going to try to get out right above this where we have the predicted highs. They kind of flattened out. We have the various indicators starting to turn bullish, looking good. So 10 cents above that predicted high. That predicted high on October the 10th was 11.71 plus 10 cents. That means that the exit would come at 11.81. And if you recall from where we entered the market, if you kept that short position that whole time, you almost had a $2.50 situation there, and like $12,500 in terms of how much of a profit you might have made on a lengthy move like that after catching that initial breakout. Now, will we catch another breakout? We don't know. We just don't know whether it's going to be a breakout that we can get on board or not. But if we look at the situation we have this predicted high. We said here the predicted high was at 1071. So 20 cents above that would turn us into a buyer. Now we have a couple of considerations here that might have kept us out. Number one, so far we haven't seen much in bullish enthusiasm based upon the news that we already have had, because nobody reacted to the freeze threat, nobody reacted too much to the drought. Secondly, we have a crop report coming up in just a couple of days? Do we want to be in a position where there's a potential for some kind of a surprise, an adverse surprise that may not be, go in our favor? So it's a decision, again, that you have to make a judgment and then manage the trade fairly carefully. The indicators say bullish, and so they say yes. And so, assuming that were the case, October 10th at that predicted high, 1171. Add your 20 cents onto that, you'll be a buyer at 1191. You'll notice that that could have come on that same day as that breakout above this predicted high. It might have come the next day. The interesting thing about this next day was October 11th, and normally, you can see that just by looking at that candle, a lot of fireworks occurred. It opened low and near the low, and then shot up. And after all this time, we think, well, that must be the crop report day. Well, this was instead the day before the crop report. So why? Why did it move up? We don't know. I don't know. Maybe somebody just got carried away with the news that China was buying some more. Just one thing kind of leads to another, and as it starts to, gain a little momentum, start to roll up higher, you start hitting stops, and everybody that might have thought or hadn't gotten out, they were going to let the market roll, well, now they're getting out because the market got beyond their stop. Whatever the case may be, it, rolled up all day and moved up higher. And so you would have been able, in a long position, provided you got in at that 1191 point, be able to ride through that crop report day with a long position, and your stop 10 cents below your entry point at 1181. As the market moves up, then you're going to move your stop until you get to today's situation where we had the market move up to the, into the range where we would have to change our stop. The predicted low today, 1222, and if we're going to put 10 cents, give 10 cents to move, it's going to be 1212 would be our stop out point. In some cases, when you start to see a big candle like that, you may want to adjust the average daily range that you're going to have to deal with, because you're going to have bigger momentum, bigger volatility than you have had in the past. So you have to take that into consideration also. But that's kind of the basic premise of what you're talking about when we're talking about a breakout type of trading. You have to have something to break out of, and I use the predicted highs and the predicted lows of vantage point as a way to get a precise price point at which I can do that. I see my previous highs, I see my lows, I see my range. Those breakouts are important too, but I like to have some of those that I can get a more precise type of an indication. I'm just going to transfer some of these properties